A very good day to all of you. Joining us from across developing and developed countries, from central banks to banks and development finance institutions. My name is Ingrid Hagen, and I manage the Frontclear Technical Assistance Program. I have the honor to welcome you to today's webinar, the third in a series of webinars organized by the ICMA and Frontclear, specifically addressing African capital market development. Today, our distinguished speaker, Mr. Atingi Ego, the Deputy Governor of the Bank of Uganda, and the panelists, facilitated by ICMA's Lisa Cleary, will tackle how Uganda is stepping up their repo market development and achievements to date, as well as ongoing activities. These webinars are but a single expression of the multiple activities where ICMA and Frontclear join forces. Thank you to ICMA's Martin Scheck and team for the shared commitment to develop emerging market and developing country capital markets. Together, we are reviewing and developing legal and regulatory frameworks towards GMRA enforceability in over 10 countries, all towards more liquid repo markets that enhance financial stability. Uganda is a solid example of how ICMA and Frontclear combine under the strong leadership of the Bank of Uganda. So without further ado, I'd like to open today's session.
Good morning, good afternoon, and good evening to you all wherever you are. Thank you very much for inviting me to address this ICMA Frontclear webinar on accelerating Uganda's repo market development. The development of the Uganda repo market has progressed since the introduction of the repurchase agreement in the year 2000/2001 as a monetary policy instrument for executing open market operations, of course, alongside the treasury bills and bonds. And it follows the abandonment of the direct monetary policy instruments for indirect monetary policy instruments in 1993. The Bank of Uganda introduced the repo during the time when the world was faced with the Y2K bug, also called the year 2000 bug or the millennium bug. There was a widespread fear that the computer systems would not interpret the last two zeros correctly, therefore causing extensive havoc through a major glitch in the system as the year changed from 1999 to 2000. Fortunately, the world, the YK2 bug only caused anxiety and nothing more. Now, fast forward, today we are considering the acceleration of Uganda's repo market, a development at a time when some might think that the Y2K bug was all but a joke compared to the havoc wreaked by the new bug, that is the novel coronavirus that has caused the coronavirus disease, what is commonly called the COVID-19. The COVID-19 has so far taken the lives of over 2.7 million people around the world, unfortunately, in a health and economic crisis like no other. In addition to the lives lost, the COVID-19 pandemic has caused a severe contraction in economic activity due to a combination of global supply chain disruptions, travel restrictions, social distancing measures, and a sudden decline in demand in 2020. Currently, the economic recovery is uneven, with the social distancing measures holding back contact-intensive sectors such as education, hospitality, tourism. So going forward, economic growth is projected between 3 to 3.5 in the case of Uganda in 2020/21, and this is projected to increase to anywhere between 4% to 4.5% in 2021/2022, and then it will get to the 6 to 7% range in the medium term. Now, the pandemic has also posed serious and unprecedented threat to the financial stability, causing severe slowdown in global and domestic economic activity, adversely affecting borrowers' financial health and increasing the systemic liquidity pressures. The Bank of Uganda responded to the unprecedented negative economic shocks of the pandemic through a trifecta of decisive interventions, including an accommodative monetary policy stance, credit relief measures for borrowers, and a liquidity assistance program for the supervised financial institutions that could have come under any liquidity stress. Bank of Uganda also announced that it stood ready to take additional measures as the pandemic evolved to alleviate emerging shocks and to support the financial stability and economic growth. The Bank of Uganda went ahead to cut and maintain the central bank rate, which is the policy rate, at the very low levels of 7% since 2020 in June to date. A prevailing environment of low and stable inflation, reinforced by a benign inflation outlook, has provided room for Bank of Uganda to adopt an accommodative monetary policy stance to support economic activity. Now, to safeguard financial stability and to alleviate the negative impact of the pandemic on the financial sector, to sustain the real economy, the Bank of Uganda took the following measures from March 2020, which many central banks across the world also undertook. And this involved the following: the provision of exceptional liquidity assistance for up to 1 year to commercial banks that would be in liquidity distress, to ensure that they continue to provide financial services, including lending to solvent businesses in need of credit. And also it was aimed to provide liquidity to commercial banks through the reverse repo of up to 60 days for eligible borrowers, and it was also subject to a rollover. The purchase of treasury bonds held by microfinance deposit-taking institutions and credit institutions to ease their liquidity distress whenever it arose, as well as providing them liquidity secured by unencumbered fixed deposits or placements with other supervised financial institutions. It also went ahead to grant exceptional permission to supervised financial institutions to restructure loans of corporates and individual customers, including a moratorium on loan repayment for borrowers affected by the pandemic on a case-by-case basis at the discretion of the lenders for up to 12 months, effective April 2020. The Bank of Uganda also directed the supervised financial institutions to defer the payments of all discretionary distributions, such as dividends and bonuses, so as to secure adequate capital buffers effective April 2020. Also, the Bank of Uganda directed the supervised financial institutions to promote digitalization so as to maintain the availability of financial services while social distancing and minimizing the use of cash. Importantly, the Bank of Uganda further directed supervised financial institutions to establish adequate occupational health and safety measures to contain the spread of the coronavirus. It also relaxed the approval of operational locations and working hours, and suspended in-person meetings of board and senior management of the various commercial banks. Now, fortunately, the COVID-19 broke out at a time when systemic risks to the financial sector were moderate, and the supervised financial institutions, on aggregate, held strong liquidity and capital buffers. And so the credit relief measures and liquidity assistance program, together with the public commitment by Bank of Uganda to do more as appropriate during the pandemic, served to forestall a potential panic due to heightened uncertainty and to maintain access to financial services amidst elevated risk aversion among supervised financial institutions. So broadly speaking, the measures by Bank of Uganda achieved against expectations. Between April and December 2020, 45% of the gross loans in the banking sector had benefited from the credit relief, and 29% of the gross loans still under restructuring at the end of the year. Credit to the contact-intensive sectors such as education, hospitality, and tourism is likely to register the deepest impact by the end of the pandemic. Further indicators of performance of the measures include the following: the majority of the beneficiaries resumed normal loan repayments after the expiry of the relief. We also saw that loans under the second restructuring rose, but they remain to be a small share of the restructured loans. The restructured loans that are past due by at least one installment will still remain high. But the macro stress tests by the Bank of Uganda indicate that most of the supervised financial institutions have adequate capital to absorb losses from the deterioration of all past due restructured loans. So far, the financial sector has remained resilient, with the majority of the financial institutions maintaining adequate capital and liquidity buffers, albeit with elevated credit and operational risks. The central financial system has held firmly through the pandemic so far, but there are signs that the sector is not yet out of the woods. To mitigate the looming risks, the Bank of Uganda has maintained a loose monetary policy stance alongside other supportive props for the financial sector. And this includes the following. First, the credit relief measures, which would have expired in March 2021, were extended by 6 months, effective April 2021, to continue aiding the affected borrowers. Secondly, the liquidity assistance for the supervised financial institutions remains in place and will be reviewed as the pandemic evolves. Thirdly, the payment of dividends and other discretionary distributions for 2020 will be subject to satisfactory internal capital adequacy assessment, which demonstrates the resilience to potential shocks and risks going forward. Fourthly, the limit of 85% on the loan to value ratio for residential mortgage loans and purchase of land, which had been introduced in June 2020, is maintained. And fifthly, financial institutions, that is, regulations pertaining to capital buffers and the leverage ratios, were gazetted in December 2020 to enhance the resilience of supervised financial institutions to shocks. On the whole, Bank of Uganda will continue monitoring the state of the economy and the financial sector to ensure that there are appropriate policy and regulatory support to solvent supervised financial institutions that may experience liquidity stress, and to aid credit extension to the pandemic as the pandemic evolves and hopefully wanes away with the universal distribution of the vaccines. So speaking of liquidity and credit extension, let me briefly touch on a few aspects of the repo market before I conclude, knowing that the panel discussion will delve into the details shortly. Since the adoption of the inflation targeting framework in 2011, the repo market became an even more critical instrument in conducting open market operations to bring the short-term interbank rate towards the central bank rate. The vertical repo is a central element in the transmission of monetary policy decisions to the economy through the money markets. Indeed, the repo was crucial in managing the build-up of structural liquidity in the banking system during the 2020 year, as government increased spending on the pandemic-related relief interventions, including the reduction of domestic arrears to suppliers, among others. So needless to say that the increased liquidity also resulted from limited credit extension during the COVID-19 containment lockdown, coupled with risk aversion among the commercial banks to lend to the private sector. The inactive repo market has given banks and investors the confidence to participate in the local financial markets by availing liquidity in a sound and operationally transparent interbank money market. Through the horizontal repo market, banks have borrowed and lent among themselves, backed by collateral, in a cheaper wholesale market since the year 2000. Between 2007 and 2010, growth in the market turnover was anywhere near 65%. However, the horizontal repo went into a lull from 2011 to 2019, partly because the collateral was pledge-based, with transactions backed by liens placed by Bank of Uganda, but without transfer of ownership of the underlying securities between the transacting parties. Also, the placement of liens on the pledge collateral involved onerous submissions of manual forms to the Bank of Uganda. So in 2014, Bank of Uganda embarked on reviving the horizontal repo market through a master repurchase agreement with a sell-by-back feature, where each leg of the transaction was final together with title transfer. At last, this left the lender exposed to subordinate position of the priority queue of claims as a secured creditor in the Uganda Insolvency Law and the Financial Institutions Act, since the securities in the repo transactions are not ring-fenced during liquidation proceeds. Accordingly, the Bank of Uganda opted for the Global Master Repurchase Agreement, GMRA, in 2016, which resolved the conundrum and has a close-up netting provision, and embarked on the process of securing the legal accommodations through the amendment of the Financial Institutions Act. This led to the signing of a memorandum of understanding between the Bank of Uganda and Frontclear in 2019 to facilitate money market development, including through the necessary legal reforms, which are now at an advanced stage. The completion of the legal reforms will set the stage for wider adoption of the GMRA that will enhance horizontal repo trading and sell buyback transactions. Also, the International Swaps and Derivative Association, ISDA, Master Agreement for Advancing Derivative Trading, and the Global Master Securities Lending Agreement, GMSLA, for securities lending. Adopting these enforceable master agreement international standards will certainly advance the development of Uganda's repo market because they bring the efficiency of the standard framework contracts among the transacting parties, they put into effect title transfer, and allow for the close-out netting in insolvency, among others. The Bank of Uganda is committed to working with the stakeholders, including the banks, Ministry of Justice and Constitutional Affairs, as well as the Ministry of Finance, Planning, Economic Development, as well as with partners such as the ICMA and the Frontclear in doing whatever it takes to advance the development of Uganda's repo market. On that note, I would like to thank MS Ingrid Hagen, together with the team at the Frontclear and ICMA, for organizing this webinar and for championing the development of the Ugandan repo market. Friends and colleagues, it remains for me to wish you fruitful deliberations this afternoon and evening, and to urge everyone to the guidelines for controlling the spread of COVID-19. Also, please to the advice of the health professions and accept the COVID-19 vaccines whenever they are available to you. I thank you for your very kind attention. Stay safe, everyone.
Thank you so very much, Deputy Governor, for these insightful remarks. You've really well set the scene for today's panel discussion. We're really very grateful for your time, so thank you. So Ingrid mentioned earlier, I'm Lisa Cleary. I'm a Senior Director here at ICMA, and I look after our repo-related activity, both from an agreement perspective and a legal opinion perspective. It's been my pleasure to work with Frontclear on a number of initiatives involving developing markets, and indeed to be involved in moderating a number of these webinar sessions. So here we have today another example of the necessary and effective cross-agency collaboration, which is committed to legislative and regulatory reform in the adoption of global market standards, including the GMRA and the development of cross-border repo markets. So I will now ask the panelists to introduce themselves and perhaps say a few words on their focus in terms of developing this market. So if we can go to Arnold first of all, please.
Thank you very much, Lisa, and good afternoon to everyone. Good morning or good evening, wherever you are. My name is Arnold Bagubwaje, and I am the Deputy Director in the Financial Markets Department. My responsibility is financial market development, so issues of repo market development, money market development fall directly under my docket, and I'm also quite passionate about taking our market to the next level.
Greetings, everyone, wherever you are. My name is Philip Karugaba. I'm a partner with ENS Africa Advocates. We have been working with Frontclear and the Bank of Uganda and ICMA in trying to make Uganda a clean netting opinion jurisdiction. Thank you.
Thank you very much. And Ronald.
Good afternoon, everyone. My name is Ronald Bianja. I head the trading desk at Stanbic Bank. I have been trading in this market for a couple of years now, almost 13. So I have suffered and enjoyed all the benefits of Arnold's work. I'm quite happy to discuss this and because it's very pertinent for me. Thank you.
Thank you very much. And Philip B, please.
Good afternoon, everybody. It's a pleasure to be here. I'm the CEO of Frontclear, and we've been operating in Uganda, as the Deputy Governor mentioned, since 2019 under an MOU with the Central Bank. And we are indeed focused on three specific areas: general capacity building and knowledge sharing. You may recall we actually launched our Frontclear Academy in Uganda not so long ago. The second area is on legal and regulatory reform, indeed, to get Uganda in the list of clean netting opinions, essentially. And third is the provision of guarantees and credit enhancement in order to try and make the interbank markets more inclusive and to assist smaller banks to be able to participate. Thank you.
Thank you very much. So in this first set of questions, what we're going to try and do is expand on the Deputy Governor's remarks and really set the scene so that we understand what the challenges have been so far, certainly some of the obstacles to the legislative agenda. So we'll go through and look at both policy strategy, more of the legal detail. We'll think about the market context, and then look out to, you know, what that means in the real world economy. So if I can go to Arnold first of all. So the Deputy Governor kindly set the scene for us, as I said, but perhaps you can provide a little bit more detail in terms of how long the development of the repo market has been underway, and perhaps indicate the policy aims which have driven this project, please.
Yeah, thank you, Lisa, once again. We have been on this journey for a while. I would say maybe from about 2013, 2014, when we revived the initiative to develop the money market, specifically the repo market. And at the time, we signed the master repurchase agreement. However, as we moved along, we realized that the MRA had its shortcomings on various grounds, as our legal experts will explain, and has partly been explained by the Deputy Governor. And so we decided to adopt the Global Master Repurchase Agreement, which is based on common law and which is applicable in our market. And I think we have made significant progress to this point. I'd like to appreciate the role of Frontclear, because to be honest with you, you know, money market development, financial market development has several building blocks. You know, you cannot do it overnight. You know, so you need some experts to hold your hand and to guide you on the right steps to take. So I'd like to appreciate Philip, Ingrid, and the team at Frontclear who engaged with us. And I'd also like to, in a special way, appreciate the management at the bank for embracing a partner like Frontclear, who have guided us and we've made significant steps to this point. But we cannot develop the repo market unless we have a conducive financial market, unless we have a liquid market, unless we have the right laws in place, the right infrastructure. Are the market participants ready to receive these new instruments or to use the instruments? Do they understand all these instruments, etc.? So Ronald is my witness, you know, on the journey that the market participants have moved from maybe 10 years ago to date. And I can authoritatively say that we have improved significantly. All our treasurers are ACI certified. Actually, there is a requirement that any dealer who goes into a dealing room must get the ACI certification within a space of 6 months from the time they get into the dealing room. So capacity has been built, and we are very confident about that. That also reflects in the numbers. You know, when you look at the turnover in our government securities market, it has increased. When you look at the utilization of other derivative instruments like swaps, and even the repo itself has increased significantly because of the capacity building that has been happening along the way. I think Philip Karugaba will talk about the developments from the legal front and where we are at this point. We've made significant steps going forward, and I think I would say that we are 90% there. The remaining steps are more or less, you know, administrative procedures. But I'd just like to talk about what has happened in terms of the kind of creating an appropriate environment for the repo to function as required. So we've had increased cooperation and increased interaction with the fiscal agent, the Ministry of Finance, and they have been quite receptive to a number of our proposals. For example, there's been a reduction in withholding tax in government securities, especially on the longer end, which has increased the liquidity on those instruments from 20% to 10%. We have had a reduction in the total number of outstanding bonds. I'll tell you that at some point, maybe 7-10 years ago, we had over 80 outstanding bonds. Now we have about 32. And the objective is to drive it down to the teens, you know. So what does that do? That increases the total volume outstanding, and that gives more assurance to investors on accessibility to securities. We've also introduced the 20-year bond that happened this year. And we hope that in the next fiscal year, that's effective July, the 20-year bond will become a calendar instrument and will probably become a benchmark security as well. Effective October last year, we introduced the primary dealership system went live. And this has significantly increased the levels of liquidity. Because as we're all aware, the mandate of primary dealers is market making. And I can authoritatively say that we've seen a significant improvement in liquidity, narrowing of the spreads, and general market development because of this primary dealership rollout. And I think we are the only country, maybe south of Sahara, and maybe with the exception of South Africa, that has a true primary dealership system. And that is something that we can be proud of. We've achieved online trading of government securities. We're now live on Bloomberg as well as on Refinitiv. So this gives us global visibility to international investors. Although this is not to the extent that we desire, our ultimate objective, and this is something that we are working on very closely with Bloomberg, is to achieve a Bloomberg valuation curve. And that will guide us so that we can be listed on a frontier or emerging market index, like the Ababi index of the ADB or the JP Morgan index. So in that way, we'll have global visibility among global investors, and that we believe will significantly increase liquidity in our domestic money market. And effectively, that also helps with repo market development. I've talked about market capacity. So we're also carrying out some initiatives from the retail market side. We're trying to link with the securities exchange so that we can have trading at the exchange, and as well as market visibility from that retail side through the broker dealers, the fund managers, and all the participants through the stock exchange. We also have an initiative to increase retail participation in securities through the mobile phone, and we've termed this project Okusevinga. This is something that is in the initial stages, but is likely to roll out in probably 2022. And going forward, we believe that all these initiatives, as well as the support that we receive from Frontclear and ICMA and all the related partners, should help us create a conducive environment for money market development, increased liquidity, as well as repo market development. I've not gone deep into the legalities because we have the legal expert here, Philip K, who will dig deeper into that side of it. But broadly, I think we've made significant progress. And once we address the remaining administrative issues, then we believe that we will have achieved significant progress, and therefore the Global Master Purchase Agreement and local participants will be able to carry out repos with all the confidence that they are legally protected. Thank you very much, Lisa. Thank you, everyone else who's all the participants, and I look forward to a fruitful discussion. Thank you.
Thank you very much, Arnold. Quite the roster of work you've described there. So I'm sure you've been extremely busy. And alongside that policy-based work and fiscal-based strategy, of course, must run legal reform. So I will ask Philip K to perhaps take us through the current legislative and regulatory environment challenges, and perhaps outline those for us in this setting the scene section of today's panel.
Thank you very much, Lisa. And I should start by thanking the Deputy Governor for giving us such a wonderful foundation for this discussion. He said it all, really. And also thanks to the Director, Bank of Uganda, for what you've heard that he's doing, and to Stanbic for being the boots on the ground, the actual parties who are playing in this market and doing the trading that we are all seeking to make much better. So coming to the legal and regulatory environment, the essential challenge for accelerating Uganda's repo market is that we need to ring-fence transactions and make them insolvency proof to ensure that for the contracting parties that their transactions or their transaction terms will not be interfered with in the event of insolvency of a counterparty. These transactions that we're talking about, ISDA and GMRA, are not governed by any specific legislation in Uganda, at least not yet. The parties enter into them under just general law of contract. You have freedom to contract and agree on the terms of your transactions. However, when it comes to insolvency, the regime is statutory. We have an Insolvency Act of 2011, and if you're a financial institution, then we have the Financial Institutions Act 2004, which deal with insolvency, which has provisions on insolvency. So ICMA Africa undertook a legal review to look at the enforceability of ISDA and GMRA transactions and make recommendations for legislative amendment that would be necessary to make the transactions insolvency proof. We found provisions in multiple legislation that would hinder the enforceability of these closeout netting and enforceability of collateral financial arrangements. And I would like to give a few examples if you have some time. The Insolvency Act, okay, it provides remedies for creditors and members of a company and the liquidator in relation to transfers, transactions, and security given within 1 year from the date of commencement of liquidation. Okay, those transactions can be reversed. So this kind of provision in an Insolvency Act would frustrate the pre-insolvency transfers of securities. There's also a risk that a liquidator of a counterparty could cherry pick transactions under GMRA or ISDA and disclaim onerous contracts and say he doesn't want to honor those. For financial institutions, there is no permission. There is no permission for set-off in an insolvency context. The Bank of Uganda may void transfers made within the preceding 6-month period at less than the appraised book value. And this term appraised book value is defined in regulations done by the Bank of Uganda for GMRA purposes. Then outright transfer arrangements of collateral would not be enforceable under Ugandan law because of a recently enacted act called Securities Interest in Movable Property. That was 2019. It invalidates any arrangement involving a transfer of assets, which is otherwise intended to act as security to a lender. Okay, well-intentioned, recent, but having this undesirable impact on what we are trying to develop here. So we then realized that we would have to do multiple amendments across multiple pieces of legislation. And for instance, the Financial Institutions Act, the Insolvency Act, the Security Interest in Movable Properties Act, the Insurance Act, the Retirement Regulatory Authority Act, and other legislation like that. Now, to navigate that terrain and coordinate multiple amendments let's just call it, it's a hazardous adventure. I will discuss the solutions that we are proposing in the next stage of the discussion. I thank you very much.
Thank you very much, Philip. Very diplomatically put, a hazardous adventure. So, you identified there a number of features or obstacles that would be detrimental to a repo-friendly environment. Suspect period, cherry picking risk, a lack of legal support for set-off, and of course, all of these things would have a meaningful impact on the market perspective. So I'd like to ask Ronald to perhaps provide us with some market context here, and the market view on the experiences of the challenges in terms of developing money market and repo activity.
Thanks for that, Lisa. First of all, I think I should appreciate our regulator. I think they are probably among the best and most progressive regulator we have on the continent. Every time the market has demanded for a product, they're actually quite receptive. They try to remove whatever remedy and create an environment where we can actually trade that whatever product we've asked for. And for repos, to be fair, they were the initial drivers when this instrument was introduced as one of the open market instruments. But like the Deputy Governor said, that initial instrument they brought was not really a true repo, because you couldn't have transfer of ownership of whatever security we were using as collateral. And once the transaction happened, there's nothing else you could do apart from hold it until maturity. I think real change started happening around 2013, going into 2016, leading into when we signed the GMRA market-wide. But even that, we found not as useful because, as Philip indicated, there were a lot of legal restrictions, and the banks were very hesitant to actually enter these transactions on the basis of that GMRA. I remember we took a while until, as a market, we compromised on a sell buyback as an addendum to that GMRA. And the idea was that would actually help in transfer of ownership, and perhaps we could trade with whatever collateral we got. But even that, to be fair, still had real risks. And most of the legal teams in these banks were not willing to sign off for us to do such transactions under that. I think the compromise we got was, first, if we can do this, we have to cherry pick which counterparty you can enter into the transaction, because there was a real risk that if insolvency happened, the bank would be left open to exposure. So what has happened is you will find that people had to choose who to deal with. Now, if you understand the Ugandan market, we are a couple of about 24, 26 banks, but there are, I think, 4 or 5 large banks in terms of balance sheets, and then the rest, which are the majority. Now, it so happened that most of the credit departments were only happy to give you limits to deal with these 4 or 5 banks. So we started trading a few of these repos, very short tenor, overnight, 7 days maximum. Sometimes I think the longest I've seen was 28 days. But the idea was that while you still have transfer of this ownership of this security after the collateral is given to you, you're still at risk if insolvency happened. And you had to be sure that you are only dealing with counterparties who perhaps in the next 7 or 30 days would probably still be a going concern. And that has been a real restriction. A few transactions have happened, volumes are growing, but the market is so limited to 3 or 4 banks trading with each other. And even the volume of transactions we're doing are not as big as we would if the legal environment actually protected us. And I have to thank Frontclear for coming into our rescue. I think this started in 2018, 2019. Philip would know best, when there were real efforts to actually look at these restrictions and find a remedy. I know for certain that if this was to happen, it would open the market extremely well. And it's where we are right now is very risky, because if you consider even the larger markets, if you consider what the US market, for example, what happened in 2019 when the repo rate moved from 2%, almost 10% in one day, the real cause was because the repo market was dominated by a few counterparties. And if any of those counterparties chooses to withhold liquidity, they can very easily push the market rates very high. So there's real need to ensure that all the 26 banks or 24 banks, or at least 10 or 20 can actually are real active participants in this. First of all, if we can go to longer tenors, 6 months, 1 year, there's a lot of liquidity that can be opened up, because once I have this collateral, I can actually turn it over several times and get real benefit from the transaction. So I'm quite excited with the things Frontclear and ENS are trying to do. I'm looking forward to this regulation that's coming up that will actually protect the banks and protect this transaction, these instruments. I do think there is hunger for the product. It would open up a lot of liquidity, not just among the 4 or 5 big banks, but even down across the 20 or so banks. Because once we have collateralized instruments, then the money market is viable. Then we can actually trade and triple the volumes we're doing now. That, I think, in short, is where we are right now, but I'm sure as we go on, we can discuss further. Thank you.
Thank you very much, Ronald. I mean, you know, it sounds as if there is huge potential there from a liquidity perspective and a participation perspective. And it's really interesting to hear the interbank view at this point, you know, and then perhaps at a later stage we can revisit it. But I'd like to ask Philip to overlay that interbank market perspective with the international view. And I'm really pleased to note, you know, how many positive mentions Frontclear has had so far. You know, I concur completely, and at ICMA we really enjoy working with Frontclear. So perhaps, Philip, you can offer us an insight into that more international and cross-border consideration.
Thank you, Lisa. Thank you, everybody. No, indeed. I think when you look at international participants within the context of Uganda, it's extremely important. Uganda has a very open economy. There are no capital controls, and there is certainly interest from offshore to participate in the local markets. And I think, as Ronald said, actually, Uganda does have quite an active swap market, although albeit that it's only a couple of counterparties that have access. So we need to think of the international side of things, and of course, international participants want all of the usual things like stable macroeconomic framework, predictable monetary policy. Uganda does great there. I mean, I think Uganda has some of the best macroeconomic fundamentals on the continent. Tax was already mentioned. We clearly need a clear and efficient tax regime. And practical things like custody and, you know, cost of trading and transaction costs, and all of these things need to be as low as possible. But I think the COVID-19 shock of last year is a good reminder, and the Deputy Governor, of course, already mentioned it. And recently in October 2020, in the IMF's Global Stability Report, there's a really good analysis on what the COVID-19 economic shock did to frontier economies. And of course, it's one of the first times where domestic bond markets were quite severely affected, right? Of course, normally in these kinds of shocks, you have a withdrawal of funds. So it's an FX problem rather than a bond market problem. And this time around, foreign exchange markets did reasonably well. Obviously, central banks used their FX reserves to support the market. But unlike the global crisis, I think a lot of central banks now have global swap lines in place, and so on. So the impact on the FX side was okay. Whereas on the bond markets, there was obviously quite a lot of stress, a combination of factors, a huge increase in supply in many countries, with governments issuing a lot of debt, of course, to respond to the crisis. And that happened at the same time that foreign participation dropped away. So lack of appetite to invest in these securities. So I think ultimately what foreign investors need is market depth. And like Ronald just said, in the case of Uganda, it's really only 3 or 4 counterparties that are able to participate. So we don't have sufficient depth in the market so that when there is a shock and there is a big change in the flow of funding, there isn't necessarily enough of a domestic investor base to absorb that change in flows. Of course, in many countries, I'm not sure if that was the case in Uganda, but many countries that have very well developed systems were able to do asset purchase programs, which I think is the first time that's ever happened in an emerging market context. But really what we want to achieve in these countries is to make sure that the market has depth. And that means not just that all 20 banks should participate, but also that the pension funds are able to participate, that insurance companies are in there, that the asset managers are able to get access, so that we have a complete market with sufficient depth, so that when there are these shocks, it doesn't result in massive yield jumps and huge dislocations in the markets. So everything that we are trying to do in Uganda is for that broader picture. And as Philip K is going to explain, we're first focused on trying to address the Banking Act, the Financial Institutions Act, but in the long run, we really need to make it possible for all kinds of market participants to have access to the market.
Thank you very much, Philip. So I think, you know, that really, now we've covered off the various different elements of how you might analyze, you know, assessing the market conditions. We've covered off policy, we've looked at legal analysis, we've taken the market perspective, and now thinking about potential from a depth and participation perspective. Maybe we should move on to looking forward and thinking about what that work plan looks like from each of those perspectives. So I'd like to invite Arnold to perhaps say a few words on the work plan for 2021, accepting that we're already kind of in the last stages of the 3rd month, but nonetheless, Arnold, can I ask you to perhaps speak to what the next steps are from your perspective?
Thank you, Lisa, and thank you, everyone. So from my perspective, number one is that we intend to facilitate as much as possible the legislative process that Philip and the other Philip, Frontclear and ENS are working on, as well as our legal counsel, because I believe the next steps are more administrative, you know, pushing the regulations to the first Parliamentary Council, to the Ministry of Finance, and then back to the Bank of Uganda, so the governor can sign them off, and then they can become law. So we intend to facilitate that process, and we believe that should happen as soon as possible. We've made significant steps, and the document is already more or less complete from our side. But in addition to that, the market needs to be ready to utilize these instruments, you know, so things like training continue. We're working with Frontclear. They launched the Frontclear Academy, and you know, working alongside the treasuries in the banks, as well as the fund managers and the pension funds, etc. You know, so that we can build capacity. You know, it's one thing to have the environment, and another thing for the market to know how to apply all these instruments. Of course, we continue to address any of the stumbling blocks, any of the rigidities in the market, because we need to create a very conducive environment, you know, things like infrastructure, things like visibility on pricing. Of course, you know, prices are very important, you know, and we also need commitment to market making. So the primary dealership system is continuously under review and under scrutiny, you know, to ensure that the primary dealers are meeting the obligations for which they have the primary dealership license. Because without market making, then you're not going to have efficient pricing. Of course, continue to push for narrower spreads, but you see this all happens when you have a very vibrant and a very liquid market. So that's mainly the activities for this year. I think we've made significant progress on the major stumbling block, which was the legal environment. But that notwithstanding, we are, as I mentioned earlier, we are working with Bloomberg to ensure increased visibility, because you know, there's a lot of global investors out there who would like to participate in this market, but for one reason or the other, they cannot see where the prices are, you know, and all that kind of stuff. So we're working very closely with Bloomberg to achieve a BVAL curve. And once we have that, then we can push for inclusion of our bonds on the frontier market index and probably an emerging market index. In addition to that, maybe that is also for the latter part of the coming fiscal year, we intend to work towards achieving local clearing on an international platform. You know, the likes of Euroclear, etc. And Frontclear have committed to supporting us as well on that front. So that is more or less that's our work plan for the year. And but it is mainly centered around increasing capacity in the market to embrace these products, as well as increasing liquidity, because, you know, without liquidity, then you know, all this work is put to waste. So thank you.
Thank you, Arnold. I mean, it's a good job none of us are going anywhere at the moment, because there's so much to do. So yeah, 2021 is the year to do it, I think. So we've mentioned it on a number of occasions throughout the panel so far, but it's very clear that at the centre almost of what needs to happen next is legal reform. And so perhaps I can ask Philip Kay to speak to the current, the plan for creating this legal environment where it may be considered netting friendly, and what the process is for getting those reforms through.
Thank you very much, Lisa, and thanks to all the previous speakers. I really like the way the debate is shaping up. So when it comes to the legislative reform, the first prize, if we could achieve it, the best thing that we could do would be a standalone netting legislation that would cut across all the earlier legislation we talked about and elevate the transactions that we have in mind above all. To say that by their institutional names, is the GMRA GMSLA transactions, you know, cannot be touched in this set of circumstances. If it has 2 horns, 4 legs, and a tail, then you treat it in this particular manner. This is the model which was adopted by Ghana that we are following and was recommended by ISDA. However, such complex legislation will take a while, not to mention that we've just come through a general election, just January, and you know, we haven't even sworn in our new members of parliament, so that it will be a while before they settle down to business. So an interim solution has been proposed and has been mentioned by other speakers, and this is to have an amendment to existing regulations under the Financial Institutions Act. This is the Financial Institutions Appraised Book Value Regulations 2019, and we would be amending this to include provisions relating to protection of the transactions under discussion. Now, a statutory instrument has the advantage of being relatively easier to pass compared to an act of parliament. The instrument, in this case by Bank of Uganda, would come into force under the hand of the governor of the Bank of Uganda, as opposed to being passed on the floor of parliament. It could happen tomorrow. Arnold, you would agree. You know, it's the governor to be moved, persuaded by experts and advisors that this is what needs to be done. So the proposed regulations would specify ISDA, GMRA, and GMSLA transactions as protected from being set aside by a receiver under the Financial Institutions Act. In other words, if there was insolvency of a financial institution, then the parties to those specified financial contracts would be free to still go ahead and conclude their transactions. I would like to pick up on what Philip B. just mentioned a while back about bringing all market players. We are intending to piggyback on a financial institutions regulation to introduce global market securities lending agreements, okay? So that if the pension funds who are sitting on large pools of capital wish to play in this market, and they are, you know, because they have to preserve capital and grow it. So if they are playing in this market and dealing with a financial institution, they know that they will be protected. So this is an excellent opportunity to bring this in. Now, the disadvantage of doing this under the Financial Institutions Act is that it will only apply, this regulation will only protect you where at least one party is a financial institution. It won't apply, for instance, if it was between pension funds or other kinds of market players. So step one is the interim solution. We get this regulation passed. A draft is in very, very advanced stages. It's bounced back and forth between all the parties involved, the Bank of Uganda legal team, Bank of Uganda financial markets team, Frontclear experts, ourselves. What's that game where you keep bouncing up and down? I think we're in draft, I don't know what number it is now. So it's in very advanced stages. It will later be introduced to the market players and stakeholders, Ugandan and international, to build market confidence in the solution and gain acceptance of it. To Ronald, to be presented to Ronald and say, does this make you comfortable? Because we've been there where a solution was suggested and the market players said, thanks, but no thanks. So there will be that socialization process where it is put before the market and discussed before it is finally approved by the governor and passed into law. That's step one, that's the interim solution. The gold prize, the first prize on solutions, the passing of a netting act will be somewhere down the road. I can't say when, we just pray that we'll be here to see it. I thank you all.
Thank you very much, Philip. I mean, there's no doubt that even, regarding this as an interim solution, it's a really positive step. And I'm sure the consequence of, many, many years of cross-agency collaboration and really, committed work in terms of improving the netting environment. So I hope that now when I turn to Ronald and ask about, how you describe the outlook from a capital markets perspective in 2021, perhaps you'd also like to reflect on what's just been announced in terms of this positive step forward and the opportunity shortly, we hope, for you to provide some market feedback in terms of what that solution looks like.
I think this for me is music to my ears, especially if the interim solution, as Philip has described it, is being pushed by BOU. Remember that our own liquidator as financial institution is a central bank. So if actually an instrument is passed and it is indeed assessed as effective, I am sure all the banks have been waiting for that. I can assure you, while we've been doing a few repos, there's been discomfort and caution in who you choose and how long. And that does not drop the market as fast as we would like. But once this is effective, then we can do longer repos. We can do 1 year, we can do 6 months. And on the back of that, we can actually do derivative products out of that. Because then once there's a real repo market, then liquidity can be assured. There are lots of players that have been waiting for this and are looking forward to this being passed. And I do think if just the passing of the sell buyback addendum created some activity, you can imagine if you have a comprehensive solution which makes credit departments and legal departments in bank comfortable that these transactions are protected. I do think we can actually more than quadruple the transactions we are seeing. We also have a difficult history as banks in Uganda. A number of banks have been closed. So when you have to speak to your credit departments, there is real concern, and they'll tell you anything can happen until you are really protected. If we can increase these securitized products and the banks feel real protected, then activity will increase beyond the few banks that seem to be acting now. We should see even cross-currency repos come in. We should see other products come through on the back of all this. I should mention that I also chair the SCI Association, which covers all the dealers across the market. And I think what I should mention is there is training that's happening. We have a list of certain trainings that want to prepare, especially some of the younger dealers, to get comfortable with these products. And I can assure you, within a couple of 6 months, we will see, and the central bank will attest, a huge move in terms of liquidity and in terms of real activity in this market.
Thank you, Ronald. There's no doubt, you mentioned it earlier as well, you know, that the potential here is really positive and could be transformative. And to your latter point, you know, education being the sort of ground floor of that. And I know that that's something that Frontclear can really assist with. So perhaps then turning to Philip B, I can ask maybe for you to outline what role Frontclear will play in moving this forward, you know, in these future developments, whether that's education or otherwise, and how that might affect things at a broader regional level, particularly thinking here about it acting as a blueprint for others.
But I think really sometimes I think our main role in what we are good at is basic coordination and consensus building. And you know, I really want to stress we've been working on this amendment to the appraised book value regulation together with Bank of Uganda and ENS for I think a year now, and we've gotten there. But the next stage in terms of obtaining market participants' input and building consensus that this actually provides the solution that is needed is what it's all about. You know, legislation by itself isn't going to change anything. It's really about getting everybody around the table and saying, guys, does this work? So when we do hopefully release it in the next few days, really ask everybody to, including the ICMA and ISDA, the local market participants, also local law firms that advise everybody to please take the time and give us the feedback in a relatively timely fashion. As Bank of Uganda has said, it sounds like the actual process for adopting it is relatively simple, but we've got to first make sure everybody is on the same page. And so we would really appreciate being able to do the next phase of that consensus building a little bit quicker, because you know, these things all take time, as we know. But we've worked hard on it, and I think we're confident that we can use this now to get the market together and get everybody to agree that this does actually move the needle forward significantly. And other than that, we will indeed continue generally supporting. We have another project with the banks which we call Tradeclear, which is where Frontclear is looking to provide a first loss guarantee that would cover any losses incurred by banks if another bank goes under or is placed under insolvency. And again, the intention there is to remove that residual risk. You can hear when Ronald talks that because of the lack of legal certainty, repo is still fundamentally seen as a credit decision, right? You're basically only lending on the basis of pure counterparty credit strength. And of course, that should be the case. But the whole point of repo is that it is a secured instrument. And if you have faith in the instrument, then it should make possible for everybody to gain access. But the idea is that in order to remove any lingering risk, we are offering to put our balance sheet on the line and absorb any losses that somebody may incur as they begin to expand the number of counterparties. And that's really hoping, together with this legislation, to kickstart the market and really get it off, to make a significant jump in a short period of time. But again, I really want to stress the most important feature right now is to get everybody around the table, to take the time to study this legislation and to get that feedback as quickly as possible.
Thank you so much. So that brings us to the end of our sort of formal panel discussion. We have had some participants submitting questions while we've been speaking, which is great. We have, first of all, a comment. Thank you very much for the updates on the market developments. A question more to the regulation and legal perspective. So perhaps I'll ask Philip K to start, and Arnold may wish to supplement. The foreign banks can play a big role in providing liquidity if the market is conducive. what measures are being considered with respect to protecting the rights of non-resident banks, especially with judgments we've seen recently, Ham Enterprise versus DTB Kenya?
Thank you very much, Lisa, and thank you very much, Mr. Fungi, for that question. Ham Enterprises versus Diamond Trust Bank Kenya was a decision of the High Court of Uganda to the effect that a foreign non-resident bank cannot lend to a Ugandan entity. For several reasons, we believe that the decision was very much in error. Diamond Trust Bank Kenya and Diamond Trust Bank Uganda have filed an appeal in the Court of Appeal. The appeal was heard 1 week ago, actually, on the 17th of March, and we are confident that the appeal will be successful. We do not believe that any intervention is required at this stage, whether by the Parliament or the Bank of Uganda, and neither do we think that any change in lending practices of foreign banks is called for. We expect the decision from the Court of Appeal to be handed down pretty soon, and we are confident it will be good for the market. I'm happy to go into more detail on this, but there's a lot of stuff that we ourselves have written out there on the net. It should be available.
I'm sure there's a lot more to say, and you know, you would need to appreciate the specificities of the case. Okay, so we then also have, again, I'm going to start with Philip K, if I may. The question is phrased, what is impeding Bank of Uganda from assenting to the required statute? I'm not quite sure that's the case here. It's more a process-driven issue. But perhaps you can speak to what happens next in terms of that process.
Like we said, the draft has been in consideration between different parties, Frontclear, Bank of Uganda, ourselves, and some experts, and it's been bouncing back and forth. I think the game is pinball. That's what I was trying to remember. Yeah, where this thing keeps going around like that. So we've done drafts and drafts and drafts, you know, almost each and every single word has been considered and reconsidered. Then the next stage is to take it to Mr. Muyanja and his people, who actually will be applying the regulation, and they will be addressing with their own team of lawyers whether this works or not. And the governor is really the final person, the final, stage of approval. And he's got a very, I don't know what the word is, enigmatic signature, which we're looking forward to, cherishing the prospect of it being placed on this instrument. Yes, so maybe 2 months before we get there. His time will come and we will have this signed. Thank you.
Thank you. We have two questions which I may try to merge into one, and that's in relation to repo activity for primary dealers. So do primary dealers have minimum repo activity in their mandate as PDs on government bonds is the question.
I can take it, since it is us who set the minimum requirements for primary dealers. So at the moment, they are not mandated. There's no minimum requirement for them to carry out repos. And the main reason is that the legal environment is still under review. However, we have impressed it upon the banks that it would be a good thing for us to have these repos and for them to practice the repos on in the current environment. And once the regulation has been passed, then probably in the new financial year, then we will have that discussion with the banks. Everything that we have as a requirement is we discuss it with the treasurers and we'll agree. But I see that in a spirit of market development as becoming one of the requirements that all PDs must have some repo activity on their books. Yeah, thanks.
Thank you very much, Arnold. Perhaps one for Ronald. How active is the overnight interbank market in Uganda? Is that something you can speak to?
Well, the actual numbers actually perhaps Arnold would have, but I would say it's very active. And I know that from being a participant, I could possibly give what sort of volumes I'm seeing just at my desk, which might be representative of what's happening across the market. We tend, we have the domestic money market, which is a bit active, but not so active. You will find that maybe between $50 to $20 million will trade daily. Most of it on the overnight bucket and possibly the seven-day bucket. Rarely does it go over. But if you go to the swap market, that is actually very active. And in any one day, we'll trade between $150 to $250 million across. That usually you'll find pricing and transactions done up to 2 years. And between overnight and 1 year, that's extremely active, and you will probably clear, even if you have $100 million in terms of a single transaction size, you will find a price for it. And you will probably find between 5 to 10 people able to price you across the entire run up to 2 years on the swap market very actively. In terms of I think the last time I checked numbers, we had grown from 2012. I think we had done about $500 million a year in the swap market. And then in 2019, we had grown to 6.9 billion. But I know between 2018 and 2020, that market also has ballooned. I do think now we are possibly, and Arnold can confirm, we should be knocking on about $19 billion or thereabout in terms of entire market activity. So it's a pretty active market, if I could say.
Thank you, Ronald. Arnold, did you want to supplement that?
Maybe the only comment would be that the growth in the swaps markets is testimony to market confidence, market capacity. We all know the swap market is a secured market versus the interbank market. So we believe that once we have the legislation in place or the legal requirements for the repo, then in the same spirit, we'd see a ballooning in repo market activity. I mean, we all saw what happened before the global financial crisis. 80% of the volumes in the advanced markets were in the unsecured market and 20% were in secured. But after the crisis, we saw a switch, 80% of the activity in the secured market and 20% in the unsecured. So that is a similar trend as Ronald is mentioning, So I believe in the same spirit, we're likely to see a significant shoot up once the regulations are in place.
Thank you very much. And I think, Philip B., you'd like to answer a question we've had submitted in terms of central counterparties. Is that correct? Perhaps.
Yes, indeed. Someone posted that there's a need for a central clearing counterparty concept, and as Arnold just said, indeed, in the global markets, since the global crisis, everyone has gone from unsecured to secured. But what's also interesting, and I don't know how well it's known, but for instance, in the European repo market, the vast majority of repo is actually centrally cleared. Because of all the benefits that come with it in terms of multilateral netting and depth and so on. I think in the context of Uganda, setting up a central clearing counterparty or similar kind of concept is a classic chicken and an egg situation. It's extremely expensive to do, and the market is just not big enough to justify it. And at the same time, there's no way that you can launch a CCP without proper netting laws and payment finality and all kinds of legislation, which is years down the road. So what I wanted to say here is that the Tradeclear concept that we've developed together with the Bank of Uganda is exactly intended to be a stepping stone towards this kind of local infrastructure that needs to be set up in the interim. And what we're trying to do is to use guarantees as a way of absorbing credit risk, just in the same way that a CCP would, but with a much lighter touch, essentially just using contractual arrangements rather than any kind of entity being set up. But the idea is that it is only a way of getting things kickstarted towards that journey of setting up to get the market to the stage where some kind of central clearing system begins to make sense.
Thank you very much. And that's clear that's the development path that it potentially needs to take. The question is, the statement, I understand the preference for a quicker interim solution as netting legislation passed by Parliament will need longer. However, do you expect such interim solution to offer sufficient comfort for a positive GMRA legal opinion conforming the enforceability of closeout netting? I know that's a very difficult question to answer in 2 minutes, Philip, but if you could perhaps give an indication of where you see it.
Thank you very much. We believe that we've taken into account we're trying to play on the existing legislation, the Financial Institutions Act. We're trying to deflect the circumstances in which, let's say, a receiver of a financial institution could come and undo a transaction. And we think that we are therefore trying to achieve some form of ring fence around those transactions. And it should succeed, like I said, if one of the parties is a financial institution. So it isn't the full answer, but at least it will get us started. And like I mentioned, we will be putting it out to the stakeholders, both Ugandan and international. I'm not quite sure who will manage the process, but I do hope that the person who asked the question would be present to review and give us a feedback on the draft. Thank you.
Absolutely. Thank you very much. And that really brings us to the end of the Q&A session. I want to thank all of those who submitted questions. I'd also like to thank all of the panelists. It's been a really interesting discussion. I've really enjoyed speaking to you all, and I really look forward to the future development of the market. So I will now pass over to Martin Scheck, ICMA CEO, who will give us some closing remarks. Thank you.
Thank you very much, Lisa. And I must say, I found this a highly interesting webinar, and I thought the quality of questions were absolutely first class. And I think it's all a testament to the level of thought and the level of progress and the momentum that's being built in Uganda. I'm really delighted to see that progress in encouraging the development of the repo market. Of course, at ICMA, we're very keen to help with that. We'd like to do whatever we can to help that particular process. And I think in our experience, when we look at the way that markets develop, one of the things that we see in terms of successful market developments comes back a little bit to what Philip B. said, which is to do with consensus, coordination, and convening power. And I think the way that all market participants are working together, and in particular, I think the role of the Bank of Uganda can't be overstated in this particular journey. I'm also very encouraged to see the legislative proposals. We all know that the repo market really is the foundation of a development in an overall capital market, and the foundation of the repo market actually is legal certainty to a large extent. And the movement towards netting legislation that we've been discussing and this very practical interim solution, albeit an interim solution, to me seems to be a very, very big step in the right direction. So I've come away from this webinar feeling very encouraged with the direction of travel, the momentum. Somebody mentioned the potential is huge for an increase in the repo market, and that's also very exciting to hear. Clearly, other people mentioned the need for continued education. That's something that is very important. And I have to say, I was extremely impressed to hear from Philip B. also I think the very sporting offer to put your balance sheet to work in terms of looking at the first loss piece on any credit defaults. So I think that's my summary of how this has gone. It's been extremely exciting, and I think all that really remains for me is to thank Ingrid, thank Michael, Lisa, Arnold, both the Philips and Ronald for your very, very thoughtful interventions. Really made it a lively and interesting seminar. And I'd also like specifically to thank both Ingrid and Philip for the really excellent cooperation that we enjoy with Frontclear, who are really the expert in this particular arena. And with that, all that remains is for me to thank you, the audience. Thank you very much for your participation.